Welcome to this video on the General Financial Rules, or GFR. These rules ensure financial accountability and transparency in government operations. Throughout this session, we will cover key rules and their significance in financial management. Let's start with Rule 21, which sets the standards of financial propriety. Every officer must treat government funds with the same caution they would exercise with their own money. Expenditure should not exceed what is necessary, and public funds should not be used for personal or unauthorized gains. All expenditures must serve a public purpose. Under Rule 22, all expenditures or liabilities involving public funds must be sanctioned by a competent authority. No financial commitment should be made without proper approval, ensuring financial control and responsibility. Rule 23 focuses on the delegation of financial powers. Powers not explicitly delegated to a subordinate authority remain with the Finance Ministry, ensuring centralized control over key financial decisions. According to Rule 30, a sanction for any new expenditure lapses if no payment has been made within 12 months from the date of sanction, unless specifically renewed. This rule ensures that sanctioned funds are used efficiently and within the allocated time frame. Rule 33 deals with defalcation and losses. Any loss of public money or government property must be reported immediately, regardless of the cause or recovery. However, minor losses under 10,000 rupees do not need to be reported, ensuring that focus is on significant financial discrepancies. Rule 34 mandates that any loss of government property valued above 50,000 rupees due to fire, theft, or fraud must be reported to the police for investigation. This ensures accountability in the handling of valuable government assets. Now we shall discuss procurement of goods and services. Under Rule 143, goods include all items procured for government use, from machinery to intellectual property like software and patents. This rule ensures a broad definition, covering all relevant goods needed for public administration. Rule 147 grants full powers to ministries or departments for the procurement of goods. If a ministry lacks the necessary expertise, they may seek assistance from the Central Purchase Organization with proper approval. Rule 148 explains that the DGS&D concludes rate contracts with registered suppliers for goods that are regularly needed by various ministries. This allows government departments to procure items efficiently without having to renegotiate terms for each purchase. Rule 149 makes it mandatory for government departments to procure goods and services available on the Government e-Marketplace, or GEM. This platform ensures transparent and efficient procurement with certified suppliers and standardized prices. GEM portal shall be utilized by the government buyers for direct online purchases, up to 50,000 rupees through any of the available suppliers on the GEM, meeting the requisite quality, specification and delivery period. Above 50,000 rupees and up to 10 lakhs rupees through the GEM seller having lowest price amongst the available sellers, of at least 3 different manufacturers, on GEM, meeting the requisite quality, specification and delivery period. Above 10 lakhs rupees through the supplier having lowest price meeting the requisite quality, specification and delivery period after mandatorily obtaining bids, using online bidding or reverse auction tool provided on GEM. The invitation for the online e-bidding reverse auction will be available to all the existing sellers or other sellers registered on the portal and who have offered their goods services under the particular product service category. The above-mentioned monetary ceiling is applicable only for purchases made through GEM. For purchases, if any, outside GEM, relevant GFR rules shall apply. The government buyers may ascertain the reasonableness of prices before placement of order using the business analytics (BA) tools available on GEM, including the last purchase price on GEM, department's own last purchase price. Rule 153 reserves certain items, like handspun textiles, for exclusive purchase from Khadi village industries and handloom units. This supports local industries while promoting transparency in public procurement. Under Rule 154, government departments can purchase goods valued up to 50,000 rupees without requiring quotations, provided the competent authority certifies that the purchase is from a reliable source at a reasonable price. Rule 155 allows the purchase of goods between 50,000 rupees and 5 lakh rupees through a local purchase committee. This committee must certify that the goods meet the required quality and are purchased at a fair market rate. Under Rule 156, ministries can purchase goods directly under rate contracts arranged by the Central Purchase Organization. The prices paid must not exceed those specified in the rate contract, and departments are responsible for the inspection and testing of goods. Rule 157 ensures that purchases are not split into smaller quantities to avoid obtaining higher-level approvals. All procurement must follow the proper authorization process based on the total estimated demand. Rule 158 outlines the process for procuring goods through advertised tender inquiries, limited tender inquiries, two-stage bidding, or electronic reverse auctions. This ensures fair competition and transparency in large-value purchases. Procurements over 50 lakh rupees must be conducted through an advertised tender inquiry. Tenders should be posted on the Central Public Procurement Portal to allow for a wide and transparent bidding process. Ordinarily, the minimum time to be allowed for submission of bids should be 3 weeks from the date of publication of the tender notice or availability of the bidding document for sale, whichever is later. Where the department also contemplates obtaining bids from abroad, the minimum period should be kept as 4 weeks for both domestic and foreign bidders. For procurements up to 50 lakh rupees, a limited tender inquiry can be used. This involves inviting bids directly from a pre-registered list of suppliers, ensuring efficiency while maintaining competition. Purchase through limited tender inquiry may be adopted even where the estimated value of the procurement is more than rupees 50 lakhs, in the following circumstances. 1. The competent authority in the ministry or department certifies that the demand is urgent and any additional expenditure involved by not procuring through advertised tender inquiry is justified in view of urgency. 2. There are sufficient reasons, to be recorded in writing by the competent authority, indicating that it will not be in public interest to procure the goods through advertised tender inquiry. For complex procurements like machinery, Rule 163 allows for a two-bid system, technical and financial bids. This ensures the technical quality of the goods while allowing for price comparison among qualified suppliers. The technical bid and the financial bid should be sealed by the bidder in separate covers duly superscribed, and both these sealed covers are to be put in a bigger cover which should also be sealed and duly superscribed. The technical bids are to be opened by the purchasing ministry or department at the first instance and evaluated by a competent committee or authority. At the second stage, financial bids of only these technically acceptable offers should be opened after intimating them the date and time of opening the financial bid for further evaluation and ranking before awarding the contract. In the case of advertised tender inquiry or limited tender inquiry, late bids, i.e. bids received after the specified date and time for receipt of bids, should not be considered. Rule 166 permits single tender inquiries in exceptional cases, such as when only one supplier exists or in emergencies where immediate procurement is required. The decision must be justified and approved by the competent authority. For standardization of machinery or spare parts to be compatible to the existing sets of equipment, on the advice of a competent technical expert and approved by the competent authority, the required item is to be purchased only from a selected firm. Electronic reverse auction is an online procurement technique where bidders submit successively lower bids during a scheduled time. This ensures the government receives the best price through real-time competition. A procuring entity may choose to procure a subject matter of procurement by the electronic reverse auction method, if it is feasible for the procuring entity to formulate a detailed description of the subject matter of the procurement. There is a competitive market of bidders anticipated to be qualified to participate in the electronic reverse auction, so that effective competition is ensured. The criteria to be used by the procuring entity in determining the successful bid are quantifiable and can be expressed in monetary terms. Rule 170 requires bid security, or earnest money, to safeguard against bidders withdrawing or altering their bids during the validity period. This security, generally between 2% to 5% of the estimated value, ensures the seriousness of bids. The bid security may be accepted in the form of insurance surety bonds, account pay demand draft, fixed deposit receipt, banker's check or bank guarantee from any of the commercial banks, or payment online in an acceptable form, safeguarding the purchaser's interest in all respects. The bid security is normally to remain valid for a period of 45 days beyond the final bid validity period. Bid securities of the unsuccessful bidders should be returned to them at the earliest after expiry of the final bid validity and latest on or before the 30th day after the award of the contract. To ensure the successful completion of a contract, Rule 171 requires the winning bidder to submit performance security. This amount ranges from 3% to 10% of the contract value and remains valid for 60 days beyond the contract's completion. Bid security should be refunded to the successful bidder on receipt of performance security. For goods and services, the performance security is 3% to 5%, and for works it is 3% to 10%. Now we shall discuss inventory management. Rule 208 requires all goods received to be counted, measured, and inspected to ensure they meet the required quality and specifications. These goods must be recorded in stock registers, preferably using an IT-based system, ensuring accountability. Rule 210 mandates that officers in charge of stores must ensure proper storage and safe custody of valuable or combustible goods. Appropriate arrangements should be made, including maintaining temperature and dust-free environments, as necessary. Under Rule 211, the officer in charge of stores shall maintain suitable item-wise lists and accounts and prepare accurate returns in respect of the goods and materials in his charge, making it possible at any point of time to check the actual balances with the book balances. The form of the stock accounts mentioned above shall be determined with reference to the nature of the goods and materials, the frequency of the transactions, and the special requirements of the concerned ministries' departments. Rule 213 requires the physical verification of fixed assets annually. Consumable goods must also be verified once a year. Any discrepancies in the stock must be investigated and recorded to maintain accurate inventory control. For libraries with up to 20,000 volumes, physical verification must be done annually. For larger libraries, verification is required at least once every 3 years. Any loss of valuable or rare books must be investigated immediately. This concludes our coverage on GFR.